Ladies and gentlemen, good day and welcome to the Brookfield India Real Estate Trust Earnings Conference Call for Q4 and FY22. As a reminder, all participant lines will be in the listen-only mode until the floor is open for questions. Should you need assistance during the conference call, please signal an operator by pressing star and then 0 on your touchtone phone. Please note that this conference is being recorded. On the call, we have the following persons: Mr. Ankur Gupta, Managing Partner, Brookfield Asset Management and Director, Brookprop Management Services Private Limited; Mr. Alok Agarwal, Chief Executive Officer, Brookprop Management Services Private Limited; Mr. Sanjeev Kumar Sharma, Chief Financial Officer, Brookprop Management Services Private Limited. We also have with us Mr. Rohan Ghosh and Mr. Rachit Kothari from Brookfield. I now hand the conference over to Mr. Ankur Gupta. Thank you, and over to you, sir.
Thank you. Very good afternoon to everybody, and thank you for joining us for our first full year conference call and the conference call where we'll discuss the last quarter of financial year 22. On behalf of the Brookfield Group and the board of the Brookfield India REIT, this has been a fantastic year in terms of our overall performance. We have laid out our full year scorecard because it's important for us to get back to all of you who supported our business with a report card, and I cannot be happier to report that across all parameters we have come out very, very strong, and the indicators that we have today in our business point towards an even stronger performance as these trends continue to play out. The macroeconomic story post the COVID waves being behind us, hopefully being behind us, or for the most part being behind us, continues to remain uncertain, largely on account of geopolitical issues. And globally, there has been increasing inflation. Some of that inflation can be called as imported inflation. Some of that is a result of supply chain issues, but inflation nonetheless. And globally, we also see a trend where central banks have, after many, many years of low interest rate regime, have started to gradually increase interest rates across the board. The value of a stable and growing business during uncertain times is even better, and that is where our business today stands out. And certainly for a sponsor group like ours, having weathered these kind of markets in the past and having come out strong, we cannot be happier with our performance to date, and also looking forward to exciting times ahead. When we launched our IPO about a year and a half or slightly less than that from today, we had pivoted our REIT with a clear mandate of strong, stable cash flows, high current returns, as well as a clear trend towards capital appreciation. On both counts, we met or exceeded our expectations and hopefully the expectations of our investors and for those of you who are covering our story. We have returned more than 8% DPU yield for the year. Our total return based on stock market performance has exceeded 25%. Inherent value of our portfolio has increased since our IPO, as well as on the ground. Leasing success has been tremendous, and I would say that leasing rates today are at par with what we saw pre-COVID. The third part of our pillar, besides strong returns, stable performance, was a growth story based on both organic and inorganic factors. With the acquisition of Candor N2, the highest quality office park in NCR region, we have accomplished our inorganic growth targets for last year. The sponsor group is very pleased to continue to support the REIT as we look to grow this business further. And our re-leasing spreads on current renewals and new space take-up remains as solid as ever. With that, I'll pass it on to Alok to talk about the business performance for last quarter and full financial year.
Thank you, Ankur. A very good afternoon to everyone. Let me know if I'm audible, otherwise I can speak louder. I'm pleased to announce that we have achieved our stated growth objective in the first year since listing. We have delivered an attractive total return of 25% plus to our unit holders, including a stable yield of 8% since IPO. Now, this has been possible through a combination of robust organic growth and the accretive acquisition of Candor TechSpace N2. The return to office trends, coupled with the expansion plan of global IT/ITES industry in India, point towards strong demand for commercial real estate in India. This is reflected in the healthy leasing momentum that we have witnessed in our assets. In the past year, we have achieved 1.6 million square feet of leasing across assets, including 1.2 million square feet of new leasing and 0.4 million square feet of renewals. Additionally, we have signed expansion options of 0.3 million square feet during the year. Our existing leases also delivered robust embedded growth with 9% average escalation on 2.8 million square feet during the year. Rental collections remain strong at 99% plus for the year. We continue to witness strong leasing demand since last quarter with 0.33 million square feet of new leasing across assets at a re-leasing spread of 28%. We had robust cash flow generation in the quarter with an effective economic occupancy of 87%, rental collections of 99.6%, and a 14% average escalation on 0.6 million square feet of leased area. Our ongoing developments are also progressing well. We have completed the new amenity block of about 0.1 million square feet in N1 in January 22 and remain on track to deliver Tower 11A in N1 in this quarter. Even with the recent leasing success, our assets have significant organic growth potential. As we lease up our assets, we have the potential to enhance our net operating income by 20 to 25%. This is expected to be driven by lease above the current vacancy and the reversion to pre-COVID operating margins. With 1.5 million square feet of ongoing discussions across assets, we are well poised to realize this organic growth headroom over the medium term. The REIT has an attractive pipeline of inorganic growth opportunities. Our identified asset, Candor TechSpace G1, is 100% complete, has received strong leasing traction during the year, and is fast approaching stabilization. In the last 6 months, G1 has achieved 0.33 million square feet of new leasing and has a same-store occupancy of 89% in March 2022. With 500,000 square feet of we are confident of realizing further leasing success in coming quarters. The sponsor group has intimated to us that they have initiated a carve-out of the rent-generating assets totaling 2.7 million square feet in Powai Business District, comprising prime office and high-street retail properties in Mumbai. This stabilized portfolio of high-quality properties has an in-place rent of ₹158 per square feet and a committed occupancy of 87%. We remain committed to industry-leading sustainable developments to deliver long-term value to our business partners and communities. Taking a significant step towards our commitment to net zero emissions by 2050 or earlier, Kensington is now operating with 100% green power sourced from Tata Power through Renewable Energy Guarantee of Origin certificate for its common areas. We remain on track to receive our first GRECB score, a leading global benchmark for ESG reporting for FY22. We'll keep you all updated on our progress in subsequent quarters. Now I would like to invite Sanjeev to provide the financial updates. Thank you.
Thanks, Alok. Good afternoon, everyone. As Alok mentioned, we have successfully delivered our stated growth objectives since listing through a combination of organic and inorganic growth. I'm pleased to announce that the board has approved the distribution of 171 crore rupees, means 5 rupees 10 paisa per unit this quarter, which is 2% higher than our guidance. With this, the REIT has achieved a total cumulative distribution of 686 crore rupees, means 22 rupees 10 paisa per unit since listing, which is a stable yield of 8% on the IPO price. Including the appreciation of the REIT units, the total returns to unit holders since listing has been 25%.
The tax-free component of distribution this quarter is 44%, as the impact of N2 acquisition is not reflected for the full quarter. In subsequent quarters, the tax-free component will likely be closer to 50%. Factoring in the recent listing success and strong cash flow generation from existing leases, we believe we will be able to comfortably maintain our existing distribution run rate. Hence, we are providing an NDCF guidance of 10 rupees 20 paisa per unit over the next 2 quarters. Our distributions have been backed by the strong cash flow generation from the initial assets as well as accretion from the N2 acquisition. As a result, our operating lease rentals for the quarter are 185 crore rupees, which is 22% higher than the same period last year. The adjusted NOI, including income support from the sponsor group, for the quarter is 213 crore rupees, which is 40% higher than Q4 FY2021. This growth is primarily driven by the addition of Candor TechSpace N2 into the portfolio. Our gross asset value has been appraised at 16,036 crores rupees, implying an NAV of 334 rupees per unit. This is 5.4% higher than our NAV as on 31st March 2021. We continue to maintain a strong balance sheet with 32% loan to value and AAA stable rating from CRISIL. With nearly 300 crores of undrawn limits, we have ample liquidity to meet any unforeseen challenges that may come our way. Thanks, everyone. With that, I hand over to the moderator for a Q&A session.
Thank you, sir. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. We have the first question from the line of Adhidev Chattopadhyay from ICICI Securities. Please go ahead.
Thanks for the opportunity. So first question is on the expiry schedule. I'm referring to slide 20. So you got 1 million sq ft of expiries this year, of which I think Powai asset is around half of that. Could you give us some color? What is the sort of renewal guidance or visibility you have on the leasing currently? That is the first question.
This is Alok. I would answer. So, as you said, the Powai asset has perfect expiry. So, we are talking, there's a large tenant there, and there's a strong interest from the tenant to renew the lease, and we are in discussion, and we are able to renew that lease in couple of in some times to come. So that's where we are. Now again, in 1 million sq ft, we have about slightly more than 1 lakh sq ft is N2. So that's there. And we think that about 50 to 60% is something we should be able to renew in this year.
Okay. So just to understand, the Powai thing is coming up in first half or second half of this year, if you would say this discussion or whatever, the clarity will come in.
Second half.
The operator.
Moderator to, I think there's some disturbance in the line.
Yes, sir. It's from the line of the participant itself. You have muted his line for the time being. You may go ahead, sir.
Sorry.
This is coming in the second half. Expiry you're talking about in the Powai.
second half of this year. Okay, fine. The second question.
Mr. Adidev, if you're on a speakerphone, we request you to go off the speakerphone as there's a lot of disturbance coming from your line.
Okay. Fine. Just a second. Sir, I'm referring to slide 7 of the presentation. So you have given this NOI bridge of the stabilized NOI run rate. Depending by when do you see this flowing through? By in another 12 months, or what is the sort of timeline you're looking at? Thank you.
So, see, we're saying the kind of leasing we're talking about, it should take about 12 to 18 months, considering the present momentum we have. Now, of course, things are looking positive. They're getting positive every quarter, but I would still, not, let me not talk of the enhanced leasing velocity. At the present momentum, I think it should happen in about 12 to 18 months.
One more question, if I can squeeze in, sir. Could you just give us the sort of physical occupancy across your parks, across Noida, Gurgaon, or Kolkata? Just the number of people coming in, just to understand what is the uptick. Thank you. That's the last question.
Absolutely important question, and that gets kind of discussed every time. But the good thing is that physical occupancy is increasing. I would say not every quarter, but every month. And the senior leadership of almost all of the tenants we talk to, they want that teams should kind of come and the offices should start humming with almost 80 to 90% occupancy by the end of this year. But as of now, the physical occupancy is in the range of 20 to 30% on a given day. But that means almost about 40 to 50% people are attending offices in a week's time. Does that answer the question?
I understood correctly. It was 20-30%, and you are hope to for it to increase to 40-50% in this quarter itself. Is that correct understanding? Or
20 to 30% on a daily basis, but not everybody is coming, every week. So on average, about 40 to 50% people are attending offices. That's what I'm saying.
I've got more questions here. Thank you.
Thank you. Participants who wish to ask a question may press star and 1 on their touchtone telephone. Participants who wish to ask a question may press star and 1 on their touchtone telephone. We have the next question from the line of Shri Karthik from Investec.
Hi, good afternoon, Ankur and Alok, Sanjeev. Great results. I have a couple of questions. One is, increasing rate environment. Last time, if I remember, you mentioned that majority of your borrowings are floating rate in nature. What sort of increase to your interest outflow do you anticipate for FY22? I'm trying to also understand why, when the opportunity presented, you've not moved on to a fixed rate liability mode.
This is Ankur. I'll take that question first. Look, we don't expect our average cost of borrowing to increase. We expect the borrowing cost to increase, but not significantly. We are still AAA rated, and it will inch up. But benchmark rates increasing are not linearly correlated with the increase in rates. To answer your second question about fixing rates, fixing rates and the flexibility are part of a conundrum that every board discusses on a as a REIT. We are expecting a significant growth in our portfolio over the coming quarters and years, and as our portfolio becomes larger, part of our debt will be fixed in nature. That being said, most of the bank debt that we have are at attractive rates, so even a modest increase in spreads will possibly not have a significant impact on our overall cost of borrowing as it stands today. And I'll give you context. A 50 basis points increase in the West is on a base of 200 basis points. A 50 or 40 basis points increase in India is on a base of 700 basis points. So the percentage impact that we see in India is minuscule compared to what makes news headlines coming from global channels.
And just to summarize that, you're also indicating that a 40 bps increase in repo need not necessarily translate into a 40 bps increase in your own cost of borrowing.
It may not, because spreads, and as our portfolio becomes more stable and income profile gets even better despite our ratings being AAA, rating agencies, lender groups, etc., look at that income profile, and possibly our spreads could compress. So rather than doing fixed rate at slightly higher spreads, and every quarter we mentioned the fact that our spreads have a lot of headroom to compress, we think that time is coming soon. So all in all, we are going to retain flexibility of compressing spreads in our cost of borrowing, and also harmonizing and laddering our overall maturity level with a bigger portfolio today and in times to come. And ultimately, you will see different duration and different type of debt coming to the REIT. Just for context, our overall borrowing in the REIT is very, very small. It's about 5,000 plus minus crores. And as the size of the REIT increases, we will be able to stratify our debt.
Thank you. And I have a slightly more global question. Because REIT is a relatively new asset class for us out here, we're trying to figure out how REITs behave, inflationary/increasing rate environment, and what your global experience tells you about overall rental during this phase.
Yes, I'll take that question. Increase in rates today is, and certainly in India, is on the back of inflationary pressures. Operating assets such as ours, or if I may be more specific, operating real assets tend to perform very well during such periods of modest inflation. That will always have a corollary to slightly higher rates. But as I said in my opening remarks, high quality assets with high quality income streams and inherent growth linked to inflation will perform even better in a slightly higher interest rate regime. And think about it, India, these interest rates are not uncommon in India, and markets have performed really well when interest rates have been in this range. Globally, REITs tend to actually perform very well during periods of growth, and India has high real growth and modest inflation. So I think REITs in India have, in fact, a better, I would say, operating current and near future than several other markets might have had.
And given the concerns on global GDP, particularly what we're seeing play out in our Indian IT services as well as some of the global tech names, does that worry you from an incremental demand perspective?
There are two parts to it. One is global GDP growth. I think global GDP growth has been quite solid in the past few years, but the share of digital economy is actually increasing. So even if GDP growth were to taper down, which I think it would surely taper down at some point, the absolute share of the services industry and certainly the digitization of the global economy is going to still be fast paced, and India will be a direct beneficiary of that. Did that answer your question?
Yeah, thank you. I'll come back in the queue again, maybe at a later time. Thanks.
Thank you. We have the next call from the line of Manish Agarwal from JM Financial. Please go ahead.
Yeah, hi. To explain, you mentioned that the renewable rate for next year, 1 million square feet expiry would be 50 to 60%. Is that understanding correct?
Yeah, that's right. That's what it is. Absolutely.
Understood.
That's
Secondly, sure. Secondly, the same store expiries have increased for FY23, and this seems to be across 2-3 assets. So any particular large tenant moving out of these assets, or what exactly is happening? What is the rationale which the company is thinking of?
So, if you really see, they're not, this is your, just give me a second. Okay, so see, now the tenants is kind of a moving out. You know, maybe there could be a small tenant moving out here and there, but people have sent us some spaces, you know, they are rationalizing the spaces, and that's what is happening. We're not seeing a tenant moving out. But also what we have seen is, in some of the cases, tenants have rented the space, and after 6 to 8 months, they come back and they ask for the same space. So that's also happening. This happened, you know, this is also happening. So while, you know, kind of expiries, we see expiries happening, but overall we see that we should be able to retain about 50 to 60% of, you know, renewals this year.
Understood. And on the CAM income across assets, so since physical occupancies are starting to come back, would it see a revival this year? Would it be higher compared to last year?
Okay, you want to answer, Sanjeev?
Yeah.
Okay.
Let me take it this. Manish, I will support this with the data. If I don't know, you remember the IPO paper or not? In those years, we were at a margin of 111 or 110%, which has gone down during this pandemic. More physical occupancy increases the margin also, because their tenants CAM model also changes from 12/6 to different models going up to 24/7. So as the physical occupancy will increase and their CAM models will increase, the CAM margin will also increase.
And just to add to what Sanjeev is saying, it has already started happening, though in a smaller way, but it has already started happening in our assets.
Sure. And we would target to head towards the pre-IPO or pre-COVID levels kind of a scenario.
Yes, Manish, that's our ultimate endeavor.
Sure. That's all from my side. Thank you. All the best.
Thank you. We have the next from the line of Murtuza Arsiwala from Kotak Securities. Please go ahead.
Yeah. Hi, sir. Just a couple of questions from my end. Is it worrisome that physical occupancy is not sort of improving? I mean, is there a sense we're getting that IT employees are reluctant to come back to office faster, and that's pushing back the recovery? That's the first part. And the second, which is a completely different question, is on the ROFO, you know, you've highlighted that the sponsors carving out the Powai assets. Any timelines? I believe the first one, which is the Gurgaon asset, should happen over the course of the next few months. But any timeline for the Powai acquisition that we can put forward?
Murtuza, this is Ankur. And I'll just elaborate from what Alok had answered in the previous question, which was along the same lines as physical occupancy.
Yeah.
Any given, in most of our offices, and this is pre-pandemic, we did that analysis at Brookfield on a global scale. So roughly 2/3 desks would be occupied on any given day. It's never been 100%. You could have people who are traveling, you could have people who are on vacation, or people, and you know, this hybrid work or flexibility of work is not something that only started now. It has been there for many decades, certainly in the technology sector. So now when we see physical occupancies in the 25 to 35% range, and these are averages, you know, some markets is even higher. And what happens sometimes is there is actually a positive feedback loop when X company has a full return to office, you know, Y company follows suit. So if you look at, let's say 30% physical occupancy, and because now there is a microscope on actually measuring the number of people coming in every day. This and as Alok mentioned, 30% physical occupancy on a given day means almost 40 to 50% people are back at office. They will not be coming every day.
Sure.
So we are probably at the 50 to 55%, 60% levels of what a stabilized physical occupancy would look like. Certainly in most markets, traffic on the street is back. Now all these people are not just shopping in malls, right? They are actually coming to work and going to their place of work. So this trend line is actually, I would say it's not worrisome, it's very positive. Now the question about whether companies will be back at all, which used to be asked of us 2 years ago, I think for the most part, barring a few examples, that has been answered by companies, human resources departments themselves, or certainly in the C-suite. That is where I would say our business is heading. So certainly very positive. I would also, and we've said this before, looking at the unemployment numbers or the employment numbers which are so positive across the world, and the fight for talent, having physical access to offices and high quality offices, not just any offices, will be a key driver for companies to attract talent. And certainly the flight to quality that we always talk about for campuses like ours becomes a key decision factor in retaining and attracting talent. I think across the board, while I won't be able to comment upon assets of a different quality, but on a more personal level, if my workplace offers me a fantastic environment to work, that is an additional impetus for us to come back to work. That can't be said about Class B or Class C assets today. So certainly those discussions are what we are seeing across the board play out. Could you repeat your second question about the sponsor group?
No, about the Powai assets. Is there a timeline that we'd be looking at by which you could close that transaction, or any indicative timelines?
Look, our actions speak for the intent. The fact that we have initiated a carve out of a REITable portfolio within the larger subset points in the right direction. The board has to take it up at the right time, but we expect that those very high quality assets at significantly high occupancy and leasing stats should be available to the REIT in short order. We can't put a month to it because the carve out is going on as we speak. But I expect that shortly after the identified portfolio of the Gurgaon asset, that asset should be available to the REIT.
Sure. Thanks so much, Ankur.
Thank you. Participants who wish to ask a question may press star and 1 on their touchtone telephone. Participants who wish to ask a question may press star and 1 on their touchtone telephone. The next question is from the line of Amandeep Singh from Ambit Capital. Please go ahead.
Thanks for the opportunity. So, firstly, I had a question on where do you see your gross debt to LTV going, which is at 32% currently, given you have a couple of assets in the pipeline across Gurugram and now even Powai. So, where do you see this stabilizing after acquisition of one or both the assets? Any initial sense on this?
Amandeep, even in our earlier calls, we have given a guidance or stated our strategy that we want to keep around or below 35% LTV always. So we will continue to maintain the same.
Thanks for this. And secondly, again on the Powai micro market, we see there are also other developers who are coming up with as large as 1.5 million square feet of graded development within the micro market. So any sense if this could impact the market rentals over the next 2-3 years when the leases come up for renewals, or do you see that the market has enough capacity to absorb graded developments? Any sense on this?
Look, it's hard to predict so far out. First, the buildings have to be built, and then we can talk about it. But I think if at all, it talks about the strength of the market, right? If quality developers and sponsors are coming up with more products, it probably means the markets are strong and they are seeing continued high absorption. And given today's land prices and commodity costs and overall cost to build, I would say that the replacement cost estimates for new projects would mean a 35 to 40% increase over our current rentals in Powai. So, all trends actually are positive, and quality supply will only make the micro markets better.
If I can just here, see in Powai, we have done almost about 0.4 million square feet leasing in last year, and this momentum is only going to, kind of gather momentum, and we are confident that we can lease more. Now, now the unfortunate part is a couple of large tenants we are talking to, we are not able to kind of offer them the space they want actually. So that is the attractiveness of Powai market. And having said that, the new supply which is going to come, first of all, the time it's going to take. And second thing is, now I really don't know, I mean, is it part of the central Powai, peripheral Powai, it is part of the ecosystem. So a lot of variables would be associated with new supply. But as Ankur said, if it's coming, it's more than welcome. Market is robust. And we are confident that our portfolio remains intact. There's no pressure on rentals.
Sure. Thank you. That's all from our side, and all the very best.
Thank you. Participants who wish to ask a question may press star and 1 on their touchtone telephone. Participants who wish to ask a question may press star and 1 on their touchtone telephone. We have the next question from the line of Shri Karthik from Investec. Please go ahead.
Thank you. In your slide 7, the NOI bridge, you mentioned or you spoke about margin recovery and how that would aid the NOI growth. Now, obviously, there will be some organic increase of CAMs as the physical occupancy comes through. But assuming that, let's say, electricity prices or water or any of those shoot up because of the inflationary pressures, that would directly flow through to you at the respective CAMs margin. Is that a correct understanding of how the economics work?
And theoretically, it works like that because our CAM is based on actuals plus a margin. But as we speak, we are investing heavily, certainly in terms of time and effort, to actually bring down energy uses in line with our ESG objectives. So the way to think about it is that these CAM margins are based on more stable operations and not sporadic increases in utility costs. But yeah, theoretically, if energy prices continue to remain very high, then our CAM margins get higher. But that's not the ideal way of running an operation, in our view.
And lastly, on Kolkata, that seems to be the only asset or micro market within our portfolio, which is obviously still not bottomed out from an occupancy perspective. What is the thought process there, given that there's a large developmental pipeline there?
Yeah, so fair point. Kolkata has been slightly behind the curve, but our sense is that it has bottomed out in terms of occupancy, and occupancy is now going to move up. And discussions are going on. And honestly speaking, Kolkata, while the movement is slow, but the kind of a number of tenants we are talking about at this point of time, that's quite encouraging. So we are hopeful that we should be kind of signing leases in next next few quarters, it looks promising.
And Sri, just to clarify, while the absolute development potential of Calcutta looks a big number, the actual development that's happening there is a very small number, and the value contribution from the Calcutta land bank is minuscule. In fact, that is a understated upside that we could have on that 14-acre land parcel that we still have in the park.
And what also caught my attention, Ankur, is that despite, let's say, occupancy going down and some of those things playing out, the asset valuations have largely remained stable. And what explains our valuer perspective?
So, look, spot occupancy on a 10-year basis contributes little to the valuations. If I may, just look at the math around a 10-year DCF model. That being said, slightly higher growth today than what we have experienced in the last 18 months. So if you had done this DCF a year and a half or 2 years ago, you would look at very little growth. But today, from this point onwards, both leasing timeline duration as well as growth in the market is higher. So if I may say that valuations were depressed last year, and they look more normal this year.
And just the last bit from my end, in your latest FY22 valuation report, the WACC rate has not really changed. Is that how it will be despite increases to the terminal risk-free rates?
I just want to clarify, these are not our valuations, these are third-party valuations. So that's one thing that we should just keep it in mind. But I think as benchmark rates go up, you could see a slightly higher WACC compensated by medium to high growth coming back into the analytics.
Excellent. Thank you so much. All the best.
Thank you. As we have no further questions, I would now like to hand over to Mr. Ankur Gupta for closing comments.
Thank you, everybody. On behalf of our team here, thank you again for your time this afternoon, and a continued thanks to all of you for supporting our business, and look forward to engaging with you again soon. Thank you very much.
Thank you. On behalf of Brookfield India Real Estate Trust, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.